Welcome to Lukebook, Money and Wealth Building, explained for Singapore, not borrowed from somewhere else. In this episode, two brothers who started with the very same $1,000 a month. One chased crypto. One quietly held a boring index fund. And the gap between them 9 years later is nothing like what you'd expect. This is a story about two brothers. They started at exactly the same line, the same year, 2017, the same $1,000 a month, the same ordinary Singapore salaries. The only difference was a single decision about what to do with that money. The older brother, Marcus, looked at the world and saw crypto, the fortunes being made overnight, and decided he would chase them. The younger brother, Daniel, did something that looked, frankly, boring. He put his money into a plain index fund every month, and then he did nothing. 9.5 years later, the gap between them is enormous, but probably not in the direction you're expecting, and definitely not for the reason you think. This is the story of the chaser and the holder. And the twist at the end might change how you see money completely. Let's meet them properly. Marcus and Daniel aren't one specific pair of people, they're a composite, built from patterns we've all watched play out, in our own families and group chats. In 2017, both are young working adults. Both earn a normal Singapore wage. Both decide, sensibly, to invest $1,000 every month, the exact same amount, the exact same discipline to begin with. If you froze the story right here, you'd say these two brothers are identical, and their futures should be identical too. They are not. Because the $1,000 is the same. What they do with it could not be more different. One brother will spend the next 9 years chasing. The other will spend them holding. Same fuel, opposite engines. Here's the fork in the road. Marcus sees crypto in 2017 and his eyes light up. People in his Telegram groups are doubling their money in weeks. This, he decides, is the future, and he is going to ride it to the top. His philosophy, though he'd never call it that, is speculation, bet on the price going up, and get out rich. Daniel looks at the same headlines and feels nothing. Instead, he sets up a boring automatic transfer, $1,000, on the first of every month, into a broad index fund that simply owns a basket of hundreds of real companies. His philosophy is ownership, buy a slice of the whole economy, and let time do the work. Speculating versus owning. Chasing a price versus owning a business. That single distinction is the whole story. And at first, let's be honest, Marcus looks like an absolute genius. 2017 is pure mania. Bitcoin begins the year around $1,000, and by the 17th of December it touches 19,783. Nearly 20 times in a single year. Marcus is up enormously. He's the smartest guy at every gathering, the one with the stories, the one telling everyone to wake up and get in before it's too late. Meanwhile, Daniel's boring index fund has done what boring index funds do, it's risen a respectable 20% or so, and nobody is impressed. At family dinners, Marcus is the star, and Daniel is the cautious little brother who just doesn't get it. If the story ended in December 2017, Marcus wins in a landslide. It does not end there. Let's see inside Marcus's head in late 2017, because this is where the trap is built. He doesn't just feel rich, he feels brilliant. And that feeling is dangerous, because he can't tell the difference between a bull market and his own genius. He starts moving beyond Bitcoin into smaller coins, the alts, where the gains are even wilder. He's in the Telegram groups at midnight. He tells his colleagues, his cousins, his secondary school friends. He even borrows a little to put more in, because if it's this easy, why wouldn't you? And crucially, as the price screams upward, he buys more, right near the very top, because missing out now feels unbearable. Every instinct that made him money on the way up is quietly loading the gun that will go off on the way down. He cannot see it. Almost nobody can. Then 2018 arrives, and the floor disappears. Bitcoin doesn't dip, it collapses. From that December peak of nearly $20,000, it falls all the way to around $3,100. That's a drop of 84%. 84. Picture it, for every $10,000 Marcus had at the top, a little over $1,500 is left. And the smaller coins he chased, the alts, fall even harder, many of them 90, 95%, some to essentially nothing at all. The genius of December has become the cautionary tale of the following summer. This is the first thing crypto teaches everyone eventually, and it teaches it brutally. The same volatility that makes the gains feel like magic makes the losses feel like a death. Marcus is about to learn what kind of person he really is. And here's what kind of person the crash reveals him to be, the same kind as almost everyone. First comes denial, it'll bounce back, this is just a dip, buy more. So he does, and it keeps falling. Then comes the slow horror as the losses deepen month after month. And finally, somewhere near the bottom, exhausted and frightened, he capitulates, he sells a big chunk at a terrible price, just to stop the bleeding. He has now done the single most destructive thing an investor can do. He bought high, in the mania, and sold low, in the despair. Meanwhile, and this is the quiet heartbeat of the whole story, Daniel has done absolutely nothing differently. On the first of every month, through the entire crash, his boring $1,000 goes into his boring index fund. He isn't even really watching. He's just buying. We should pause on Daniel, because his com looks like a personality trait and it isn't. It's a structure. Daniel is not smarter than Marcus. He is not more disciplined by nature. He simply built a system that doesn't require him to be brave or clever in the moment. The transfer is automatic, so he never has to decide to invest during a scary month. He owns hundreds of companies in one fund, so no single failure can wipe him out. And he's chosen, deliberately, to be bought, to treat his portfolio like a fixed deposit he isn't allowed to touch. When the market falls, his automatic purchase simply buys the same companies cheaper. Where Marcus feels every twist in his stomach, Daniel feels nothing, because he engineered the feelings out. Boring isn't a lack of ambition. For Daniel, boring is the strategy. The next 2 years test both of them quietly. 2019 is a slow healing, the index grinds upward, crypto stabilizes off the bottom. Then 2020 brings the pandemic, and for a few terrifying weeks in March, everything falls at once, stocks and crypto together. This is the moment that breaks a lot of investors. But watch the difference. Marcus, already burnt, is gun-shy and out of dry powder. Daniel. On the 1st of April, in the depths of the fear, his automatic $1,000 goes in and buys the whole market at a discount, and he barely notices he's doing something brave. By the end of 2020, markets have roared back. Daniel's steady, unspectacular pile has grown to a meaningful sum. He has never had an exciting year in his life, and he is winning. And then comes 2021, the big one, the mania to end all manias. Bitcoin doesn't just recover, it explodes to an all-time high of $69,000 in November. The entire crypto market is suddenly worth $3 trillion. There are dog coins worth billions. Teenagers are posting screenshots of life-changing gains. And Marcus? Marcus is back. The pain of 2018 fades, as pain always does in a boom, and the old feeling returns, bigger this time, because now he knows how it works. He throws everything he can scrape together back in. He goes deeper into else. He starts using leverage, borrowing to amplify his bets, because in a market that only goes up, leverage feels like free money. This is the setup for the most expensive lesson of his life. At the very top, in late 2021, Marcus opens his app and sees a number that makes his heart race. On paper, his crypto is worth around $320,000. $320,000. From a working adult putting away $1,000 a month, that feels like a miracle, like he's cracked the code that the boring people never will. He starts doing the maths on early retirement. He looks at his brother's plodding index fund, worth a fraction of his pile, with something close to PT. And here is the fatal thought, the one that gets almost everyone: he decides not to sell. Why would he? It's going to $1 million. Selling now would be admitting the ride is over, and the ride is everything. So he holds his lottery ticket, and he keeps buying more. Let's name the track precisely, because it is the center of this whole episode. A paper gain is not money. It is a number on a screen that becomes real only at the instant you sell. And the cruel design of a mania is that it manufactures exactly the emotion, greed, certainty, invincibility, that stops you from ever selling. The people who feel riches are the least willing to lock it in. Marcus at $320,000 is not a wealthy man. He is a man holding a winning lottery ticket who has decided that cashing it would be cowardly. Daniel will never have a moment this exciting. He will also never have a paper fortune evaporate, because he isn't holding a number, he's holding hundreds of real businesses that earn real money, and he's not trying to time anything. One brother owns a feeling. The other owns the economy. Then 2022 arrives, and it doesn't crash gently, it detonates. In May, a coin called Terra, with its sister token Luna, simply implodes. Luna falls from around $119 to essentially zero in a matter of days. Around $40 billion of value evaporates almost overnight. It was supposed to be safe, a lot of very confident people swore it was. Its founder, Do Kwon, would later be sentenced to 15 years. And Marcus, like so many chasers reaching for the highest yields, had a real chunk of his money in exactly this kind of thing, a can't-lose alt-paying returns that, in hindsight, were obviously too good to be true. That money is now gone. Not down. Gone. Zero. The first piece of his $300,000 paper fortune disappears completely, and it is never coming back. And then, before the year is even over, the second blow. In November 2022, FTX, the third biggest crypto exchange on Earth, with over 1 million users, the one with the stadium naming rights and the celebrity adverts, the one everyone trusted, collapses in a matter of days. It turns out there was an $8 billion hole where customer money was supposed to be. People who simply kept their coins on FTX, doing nothing risky at all, woke up to find their accounts frozen and their savings gone. This is where crypto people repeat their hardest-won proverb: not your keys, not your coins. Marcus had funds on an exchange like that too, because that's where you trade. Another piece of his fortune vanishes, not to a bad bet this time, but to simple counterparty failure. The pile is collapsing from every direction at once. Let's total the wreckage, because it's worse than a simple price drop. Marcus didn't just write Bitcoin down. He had an alt go to zero. He had money trapped on a failed exchange. And the leverage, the borrowing that felt like free money in the boom, turned vicious. As prices fell, he got a margin call and was forcibly sold out near the very bottom, locking in the loss at the worst possible moment. Bought high, sold low, but mechanized and amplified. From a paper peak of $320,000, he is reduced to a small fraction of what he put in. And the damage isn't only financial. There's the shame of the colleagues he told to buy. The strain at home. The months of checking the app at 3 in the morning. He didn't just lose money. He lost years of peace. Now cut back to Daniel during this same apocalyptic year, and the contrast is almost funny. For Daniel, 2022 was just a soft year. His index fund dipped, the way markets do. His statement was a little lower. He shrugged. He didn't read the lunar headlines with a knot in his stomach, because he owned none of it. He didn't care about FTX, because his money was in a plain, regulated fund holding real companies, not on a crypto exchange. And on the first of every single month, all through the carnage, his automatic $1,000 went in and bought those companies cheaper than the year before. While Marcus was being margin called at the bottom, Daniel was calmly accumulating at the bottom. Same market, same fear in the air, and one brother was a victim of it while the other quietly fed on it. Now, you might be thinking Marcus was just unlucky, or reckless, or stupid. He wasn't. He was typical. And the data on this is genuinely sobering. Studies of retail crypto traders find that around 84% of them lose money in their first year. 84%. More than half of new traders lose almost everything they put in. And among those who try to actively day trade it, the failure rate climbs towards 97%. The two biggest causes researchers identify are exactly Marcus's two sins, poor research, and FOMO, the fear of missing out that makes you buy at the top. So when we watch Marcus chase, FOMO, leverage up, and blow himself up, we are not watching an idiot. We are watching the statistically normal outcome of the chasing behavior. He didn't get unlucky. He played a game that is designed for the player to lose. And this isn't some faraway American story. It's deeply Singaporean. At the peak, around 40% of Singapore residents had owned crypto. Even now it's roughly 1 in 3, with awareness near universal among the young. We are right in the middle of this. And the cost has been real. Singaporeans lost over $1.1 billion to scams in 2024 alone, up 70% in a year, and crypto-related scams made up about a quarter of that, when it had been under 7% the year before. One victim lost $125 million to a single scam. This is exactly why our regulator, the MAS, now bans buying crypto on credit, bans the flashy incentives, and forces retail investors to pass a risk knowledge test first. The authorities watched 1,000 Marcuses get hurt, and built guardrails. But the story isn't over, and crypto, true to form, refuses to stay dead. Across 2023, 24 and 25, it rolls back yet again. Bitcoin climbs past its old highs and reaches a brand new peak of just over $126,000 in October 2025. And here's the tragic part for Marcus. Having been burned, undercapitalized, and scared, he hesitates through the early recovery, and then, as it nears the new top, the old FOMO grabs him one more time and he buys back in near the peak. Again. Meanwhile, Daniel's boring index has done what it always does, it just kept climbing. The Singapore market in particular had a strong couple of years. Daniel never bought at the top or sold at the bottom, because he never tried to pick either. He just kept feeding the machine. Which brings us to today, June 2026, and crypto, with impeccable timing, is in the middle of yet another crash. From their October peak of 126,000, Bitcoin has roughly halved, back down to the low 60s. In a single week this June, the crypto market shed around $390 billion, its worst week since the FTX collapse. So Marcus, who FOMO'd back in near the top, is underwater again. For the third time in 9 years, he has watched a fortune swell and then shrink. He is exhausted. He is, frankly, poorer than when he started chasing. And Daniel doesn't even know there's a crypto crash happening, because it has nothing to do with him. His $1,000 went in on the first, like always. Let's finally, properly, add up the score. Here is the score, after 9.5 years. Both brothers invested the exact same amount, $1,000 a month, which adds up to $114,000 of their own money, each. Daniel, who held the boring index and did nothing exciting, now has around $173,000. His money grew by more than half, steadily, while he barely paid attention. Marcus, who chased the most exciting asset in human history, now has around $72,000. Read that again. 72. That is less than the $114,000 he put in. He didn't just underperform his brother, he lost money, in absolute terms, over 9 years, in an asset that went up massively. The boring brother has more than double the exciting brother. That is the entire ball game. But the cold numbers actually understate the tragedy, and this is the part that should stay with you. Marcus didn't simply end up with less. He once had, on paper, $320,000. He was, for a brief shining moment in 2021, more than 4 times richer than his careful brother. He held a genuine small fortune in his hands, and let it run through his fingers, because cashing it in felt like quitting the game. So Marcus's real loss isn't measured against Daniel. It's measured against himself, against the version of Marcus who could have sold even half at the top and walked away sad for life. Look at the two journeys side by side. Daniel's is a quiet, boring line that just goes up. Marcus's is a breathtaking mountain, straight up to 300,000, and then all the way back down into a hole. So why did Daniel win? It's tempting to say crypto is bad and index funds are good, but that is the wrong lesson, and we're going to dismantle it in a moment. The real reasons Daniel won have nothing to do with which asset he picked. He won because he owned, instead of speculating, he held real businesses, not a bet on a price. He won because he diversified across hundreds of companies, so no single failure could ruin him. He won because his system was automatic, so his emotions never got a vote. He won because he never used leverage, so a bad month could never wipe him out. And above all, he won because he held instead of chasing. He never had to be right about timing, because he wasn't trying to time anything. He just needed to survive and stay invested. And he did. But now the honest twist, and it's important, because without it this episode would be a lie. You might assume the lesson is that crypto is a scam and Daniel was right to avoid it. So let me tell you something uncomfortable. If Marcus had taken the exact same money and simply bought Bitcoin and never sold, no else, no leverage, no panic, no chasing, just buy a bit every month and hold it like Daniel held his index, he wouldn't have ended with $72,000. He would have ended with well over $500,000. He would have crushed his brother. The asset, in this particular window, was not the villain. Bitcoin went up enormously. Marcus's problem was never what he bought. His problem was entirely how he behaved. Same coin, same 9 years, holding it would have made him rich, and chasing it made him poor. Now, before you close this video and go all in on Bitcoin, stop, because that big number is a trap wrapped around a truth. It is hindsight, and it is survivorship bias. We know, now, that Bitcoin survived and soared. We are looking back at the one coin that made it. But the same $1,000 a month, put into Luna, or into the FTX token, or into any of the thousands of date coins that were just as confidently promoted, would today be worth nothing at all. For every Bitcoin holder who got rich, there are graveyards of people who held with exactly the same conviction and lost everything. And even holding Bitcoin itself demanded surviving 5 separate crashes of 50 to 84% without selling, which is precisely the thing 84% of people cannot do. The buy and hold winners weren't smarter than Marcus. They simply, somehow, didn't sell. So here is the real lesson, the one worth carving into the wall. It was never crypto versus the index. It was chasing versus holding. Speculating versus owning. Marcus and the lucky Bitcoin holder bought the same asset, one became poor and one became rich, and the only variable that changed was behavior. And Daniel, with a completely different asset, one using the exact same behavior that would have made Marcus rich in crypto, pick something you believe will grow, own it, diversify your risk, don't use leverage, and then have the temperament to hold on and do nothing for years. The discipline is the asset. The temperament is the edge. You can apply it to an index fund, to blue chip stocks, even to Bitcoin if you must, but without it, no asset on earth will save you, and with it, you barely need to be clever at all. Let's make the difference between chasing and owning completely concrete, because once you can see it, you can't unsee it, and you start spotting which one you're doing. The chaser bets on a price going up, the owner buys a slice of something that produces real value. The chaser is driven by emotion and the fear of missing out, the owner runs a boring automatic system. The chaser reaches for leverage to go faster, the owner uses only money he actually has. The chaser has to time the market perfectly, twice, when to get in and when to get out, the owner just needs time itself. The chaser concentrates everything into one hot bet, the owner spreads across hundreds. One of these is exciting. The other one is how almost every quietly wealthy person you will ever meet actually got there. Now, I can hear the question, so let's answer it honestly, does this mean you should never, ever touch crypto? No. That's not what this story says, and I'm not here to tell you what to buy. What the story says is much simpler. If you choose to own some crypto, treat it the way you treat a lottery ticket, not a retirement plan. Use a small slice you could lose completely without it changing your life. Never use leverage. Never chase the hot new coin your friend swears by. Never put in money you need soon. And let the boring, diversified, own things, the index, the blue chips, the bonds, do the actual heavy lifting of building your wealth. The problem was never that Marcus owned crypto. The problem was that crypto owned Marcus. Keep it small, keep it calm, and keep it in its place. So where are the brothers now, in 2026? Marcus is okay, that matters, and it's worth saying. He's wiser, humbler, and slowly rebuilding. The most painful part is that he's now doing exactly what his little brother did from the start, a boring automatic transfer into a diversified index fund, every month, no drama. He arrived at the right answer, he just paid an extraordinary tuition to get there, in money, in years, and in peace of mind. 9 years of stress and a 5-figure hole, to learn a lesson Daniel got for free by simply being patient from day one. Marcus sometimes says it was the most expensive education he ever bought. The good news is he's still young enough for the boring strategy to work. The compounding doesn't care about his past. It only cares that he finally stopped chasing. And Daniel? Daniel is exactly where you'd expect, doing the same dull thing he's done for 9.5 years. $1,000, on the first of the month, into the same diversified fund. He has never had a story worth telling at a party. He has never felt the electric high that Marcus felt in 2021, and he has never felt the gut-dropping terror that followed. His line on the chart just goes up and to the right, boring and relentless, $173,000 and counting. He didn't beat his brother because he was smart, or lucky, or because he picked a magic asset. He beat him because he was patient, automatic, diversified, and calm, for a long time. He let boredom make him rich. And the quiet truth is, boredom is available to absolutely everyone. There's one more idea hiding in this story, and it's the deepest one. Daniel's age was never a brilliant year. He never had one. His age was the complete absence of a catastrophic year. He never went to zero on anything. He was never forced to sell. He never blew himself up. And because he survived every single year, the compounding was allowed to do its slow, magnificent work, uninterrupted, for almost a decade. Marcus, by contrast, had several spectacular years, and one of them nearly ended him. In investing, the size of your wins matters far less than whether you avoid the loss that takes you out of the game. You cannot compound from zero. Survival isn't the boring part of the strategy that you tolerate to get to the exciting part. Survival is the strategy. Stay in the game long enough, calmly enough, and time does the rest. Let's be scrupulously honest about the limits of this story. Marcus and Daniel are composites, representative, not a single real pair. Some crypto chasers did do better than Marcus. Many, in fact, did far worse and lost everything, which is what that 84% figure really means. The index is not magic and not safe. It falls too, sometimes hard, and Daniel will absolutely have scary years ahead. Past returns do not predict future ones. The next decade could look nothing like the last. Crypto could rise tenfold from here, or have a gain. Nobody honestly knows, and anyone who tells you they do is selling something. This was never a forecast about any asset. It is a story about two human temperaments, and which one the market quietly, patiently rewards over time. Take the behavior. Leave the prophecy. And the usual, important line, none of this is financial advice. It is not anti-crypto, and it is not pro-anything. I'm not telling you to buy an index fund, or to sell your Bitcoin, or that any number in this video is right for you. This is a mirror, not a map. Because in the end, the real question this story asks has nothing to do with crypto or index funds at all. The real question is about you. When you look at your own money, your own habits, your own reaction the last time the market dropped, are you Marcus, or are you Daniel? Are you owning, or are you chasing? Are you building a system, or are you hunting a feeling? You don't get to choose your luck. But you absolutely get to choose which brother you are. And that choice, repeated for years, is the whole game. So what do you actually carry out of this, whatever you choose to invest in? 6 things, and not one of them is a ticker symbol. 1. Own, don't chase, buy things that produce real value, not just a price you hope goes up. 2. Diversify, never let one bet have the power to ruin you. 3. Automate, take your emotions out of the decision, because in the heat of a crash or a mania, your emotions are your enemy. 4. Think in time, not timing. You don't need to be right about when, only patient about how long. 5. Never bet what you can't afford to lose, and never use leverage you don't fully understand. And 6. The one underneath all the others, survive. Avoid the catastrophe. Stay in the game. Because the market doesn't pay the exciting. It pays the patient. 2 brothers. The same year, the same $1,000 a month, the same dreams. One chased the most thrilling asset of his generation and ended up with less than he started. One held something so boring he could barely stay awake, and quietly grew a small fortune. And the difference between them was never intelligence, or luck, or even the assets they picked. It was temperament. The patience to own instead of chase, and to hold instead of flinch. That's it. That's the secret the whole industry is too excited to tell you. If this story made the difference between investing and gambling a little clearer, do me a favor, give it a like, and subscribe to Lukebook, so the next story finds you too. Be the brother who holds. And I'll see you in the next one. Thanks for watching. If this made building wealth in Singapore a little clearer, give it a like, and subscribe to Lukebook so you don't miss the next episode. See you in the next one.